What is the difference between earnest money and down payment? And in fact, I'm going to do you one better and add something to it. What's the difference between option money, earnest money, and the down payment? So these are all terms that are used when purchasing a home. So the option money is going to be money that you as a buyer would write a check for. And I would say generically speaking, it's usually about 100 to 300 bucks. Maybe it's 500, but small-ish in terms of amount, where it's 100 to 300 bucks that you're writing when you put in an offer that basically says, hey, Mr. Seller or Miss Seller, here's some money. And if I decide to not buy this house, you get to keep this money. Here's the inconvenience fee for taking your house off the market during the option period, which you and the realtor, if you're using a realtor, you would put on your contract. About 10 days is kind of the default. So during this next 10 days, here's 100 to 300 bucks that you at least get something for your time and shows that I'm serious enough. So that's the option money. It's a check written when you execute the contract. The second check you would write when you execute the contract is the earnest money. And the earnest money is usually, rule of thumb, is 1% purchase price. So on a $500,000 home, that's $5,000. So you'd write two checks, one for your 100 to 300 bucks. That's the option money. And then the second for your earnest money. And that's the 1%. So this example, $5,000. So the option period is, in my example, the first 10 days. Well, on day 11, if you continue to move forward and decide you want to buy the house, day 11, that's when the earnest money goes live. And the earnest money then kicks in and says, man, if you just change your mind on day 12 because you don't like the brick color, you lose your option money, which you're going to lose anyway if you don't buy the house, and you would lose that earnest money. So the earnest is the kind of the teeth that says, man, you've had your time for the first 10 days to do your homework and decide if you really mean it. The earnest money is what kicks in and says, here's when it's real. There are instances and outs in your contract, so check with your real estate agent, that says like, hey, if this doesn't raise, you can get your money back. Hey, if there's a financing period, a lot of times that's 20 days. That says, hey, if I can't get financing squared away, so that's where the appraisal come into play. That's where if you lose your job or something that the lender finds out, you get your earnest money back. But after, let's say, the 20 days in this example, on day 21, they don't matter. You don't close, you now can lose that earnest money. So then at closing, 30 days go by, your first 10-day option period, then the next 10 days makes those 20, earnest money goes in, and then, or not goes in, but goes live, if you want to call it that. And then you close. Well, when you go to closing, the cool part, that $100 in my example, or whatever that option money was, and the $5,000 in this example, the earnest money, all that gets credited to you at closing. So whether you want to think of it like that's part of your down payment, or whether you want to say, hey, that's my closing cost, because let's say it's a VA loan and somebody has to come with $0 for a down payment. Cool. All that money can then go to pay for closing cost. And here's what's really funky. On VA loans, let's say it's zero down payment, and let's say they negotiated where the seller pays all the closing cost. So at closing, there may not be anything for them to pay. They get their money back. That's rare, but I'm just making the point that you do get credit. These are your funds, your money. You get credit for it at closing if you need it, which most people do. But on the rare case where there's a VA loan where somebody's getting all their closing costs paid for and they're zero down, you can even get the money back because, again, it's your money, so long as you abide by the contract and you buy the house. If you don't buy the house, you'll lose that option money for sure. And the earnest money, most cases, you'll get it back unless you just, something happened the very last minute, you just didn't want to buy the house. That's kind of your fault for doing that. So the only time we've had in my illustrious career, knock on wood, been doing this for over 20 years, the only time we've had somebody lose their earnest money was a doctor who was not yet divorced, against our recommendation, wanted to buy the house, said the soon-to-be ex-wife would play nice. She did until the day before closing. And then she said, nope, I'm not doing it unless these things happen in the divorce decree, which he was not willing to do. So he had to walk away, didn't buy the house because the divorce wasn't finalized. And he did lose a big earnest money check. So he did walk away. He knew he'd lose the check, but he wasn't willing to concede whatever it was that the ex-wife wanted. So we do recommend, if you're getting divorced, let's wait till it's finalized before doing it, because that's the only instance that I can recall that we've lost the earnest money. So, and we didn't do it. It's his choice. So hopefully that answers the question between option money, earnest money, and down payment. Certainly, if you got questions, reach out to the Mortgage Mark team. You know, we're always here to help. And when you think mortgage, think Mark.